Welcome to Investing Insights, partnered by Right Property Group. This is your host, Phil Tarrant.
G'day everyone, Phil Tarrant here. I'm the editor of Smart Property Investment, and welcome to episode 2 of our education series with the Right Property Group. Thanks for tuning in again. For everyone who is new to this series, it's a new initiative that we've created. We've joined forces with the Right Property Group to really get into the meat of property investing. So what we're going to do is chat through a whole bunch of different issues and scenarios over the coming period to really give you guys the type of information you need to know to be a better property investor. So our first episode was the 11 things successful property investors don't do. If you haven't listened to it, go and tune in. If you have listened to it, make sure you go back and revisit that, because we all need a little bit of guidance and motivation sometimes, and we might lose our way. So some really good points in there if you find yourself stuck or making the wrong calls that you can look to revise or revisit and take action with. Today's episode number 2, we're going to look to debunk the most popular property myths, and there is plenty out there. I've been investing in property for 5 years, and I've been writing about it as a journalist for well over a decade, and I think I've heard all of them, but there's still some that come out every single day, some new myth which sometimes make your mind boggle. So I've been joined by the guys from Right Property Group, Steve Waters and Victor Kumar, to come to the studio and chat through this with us. Guys, how you going?
Yeah, well, how you doing?
I'm good. Victor, how you doing, mate?
Pretty good, mate.
So you probably hear more of these than I do on the front line every day working with investors. All the myths, sometimes mysterious, sometimes factual, and sometimes and often a lot of people get caught up with these things and it stops them investing. What do you reckon about property myths?
I think there's plenty of them, but some of them are really well peddled too, and they'll give you every reason as to why they're true. But once again, common sense prevails, and often if it's too good to be true, it is. Probably the biggest one, or it's in the top 5, is that property is a set and forget asset class, and they'll usually paint that up with the wording passive income, and it just really grinds me, because at the end of the day, property is about the furthest thing from passive as you could get. It's something that you need to continually check, monitor, drive, manage. But people will just say it's passive, buy it, pay it off, collect your $400 a week rent for the rest of your life, you'll never do anything.
And
which
happy
is
days.
just rubbish.
Do you think a lot of people in the property space perpetuate myths for their advantage?
People talk in cliches, and when you have someone that starts talking in cliches, you want to question the real knowledge behind it, because a lot of times they use cliches just to mask what the property really is, or what the strategy really is. And a lot of times, set and forget, all of these sort of cliches, they don't really mean anything. It's just been touted around for so long that it's just become part of the vocabulary of the industry.
Yeah, good point.
So let's debunk. I feel like Mythbusters.
Mythbusters.
But the Mythbusters for property.
Property Mythbusters. Trademark that.
but let's talk about it. So we're going to go through 6 property myths, and these are the key ones in this episode of our education series. And this first one, property is set and forget. Who would perpetuate something like that? Who would want you to think that property is set and forget?
I think anyone that was going to derive income from you buying property. Now, unfortunately, the industry, as we all know, has got some pretty undesirable characters throughout it.
Property spruikers, let's call them what they are.
There's property spruikers, whether they're masked up as an advisor, whether they're a marketing company, an accountant and financial planner, whatever it may be, there are some of those characters out there which we're all against. But I think those are the type of people that will use those cliches, as you say, Vic, purely because it's just great verbatim, where they'll just wrap you up into something that you want to hear.
Okay, so it's one of the myths is set and forget. What is property really like, Victor? How much attention does it need?
It is hard work,
Yeah.
Especially when your portfolio gets bigger and you're faced with new situations like tenants not paying rent and then holding the property at ransom. And if you're self-managing, as an example, definitely not set and forget, because it's a bit steep learning curve. Been there, done that. A lot of daily, if not weekly, routines that you need to have, such as checking where your rents are, making sure that, as we spoke in the last episode, making sure that the direct debits for your mortgages have gone through. So, it's not passive in any way, shape or form. It is a fluid thing. You need to adjust how you're managing the property and what you're owning in line with what the market's doing. So it's never set and forget in that sense.
And, before we go on, though, I don't want to make this this myth-busting episode all negative. I mean, we're just going to talk about some of the crazier things, I suppose, right. that aren't quite true. And Vic touched on it. I think managing your portfolio, or whether it be one property or 100, is so crucial. And if you don't have the time to do it because of the size of your portfolio or because of your profession, then have someone do it for you. I'm not talking about collecting the rent. I'm talking about
keeping on top of the paperwork.
keeping on top of the paperwork, keeping on, like for us, all our clients, we provide them online portfolio trackers. We encourage them sternly to fill them in at the end of every month so that everything's up to date and we can monitor that. But if you don't do that, it'll get out of hand pretty quickly. And as you say, direct debits, money in, money out, mortgage rates, the amount of times that we sit with people that they're paying 0.75% over the odds in terms of interest rates is unbelievable. It's just not minding your own business.
There's probably a couple of points I'd make about this myth, guys, is property investment, it's a business, right?
It is, yeah.
So you wouldn't create a business thinking you don't need to do everything all day on it or any day and well, just leave it alone. So it is a business property investment. You need to make sure that the best businesses, the ones which are process orientated, they're businesses that you can scale, they're businesses that can run effectively with the right type of management. You need to think about property the same as that. And the other point I'd make around this is at different points of time, as an asset class, property is going to require different levels of connectivity. Yeah. So if you buy well and you get your systems and processes in place, as in the management of those properties, every now and then just needs a little massage and make sure it's going down the right track. But then if you're in a buying phase, property's going to take a lot more of your time.
Absolutely.
So it's got to ebb and flow based on your strategy.
And the size of your portfolio. But I think you've hit the nail on the head. If you want to scale your business, being your portfolio, then you need to have your systems and your procedures in place.
That's right.
You need to review it enough and you need to make sure that everything's running smoothly. Otherwise, you can't scale it.
It's good. So our next myth, Victor, that we're going to try and debunk here is that with property and property investment, all you have to do is collect the rent. So it's sort of a little bit connected with our first one about property being set and forget. But do a lot of people think they invest in property? They go, yeah, look, my rent will come to my bank account. Happy days.
You're right. It does go hand in hand with the set and forget mentality. With the rents, of course, you got to monitor it. And one of the key things that I find with the property investors I mentor is that one of the drawbacks is that they actually don't look at their statements as it comes to the inbox, or if they've got physical statements. I get my statements electronically every fortnight, so I'm actively managing it in that sense. Yeah, so it's not all about just collecting rent. You've got to look at it from the whole holistic view. Your insurances should be in place, both for the property and for yourself. You're able to earn the income, so you have that risk mitigation in place. Reviewing your interest rates as the market changes, reviewing your rents as they change. So there's a whole lot of background work that you need to do for the rents to just come in.
Yeah, it's part of your team. And what you mentioned is you get your statements online every fortnight. So
yep.
What we encourage people to do is actually create a different email address just for your anything property related. So, it might be Steve's Properties at, blah, blah, blah. And that way anything and everything property related comes to that rather than me looking through thousands of emails and getting lost in transition. The other thing that was interesting that Vic mentioned was that he gets his statements and therefore his rent dispersed fortnightly. Now, that's something that you could do if cash flow was of the app. You're squeezing every cent out. But just be aware that if you do ask your property manager to disperse rentals or your rent monies on a fortnightly basis, most of them will charge for the privilege as well. So you'll expect to pay higher fees and charges, yeah.
And it goes back also to this analogy that a property investment portfolio is like running a business. It's how do you run a business? It's about cash flow, right?
Cash flow's king.
That's it.
Money in, money out. And ideally, you want the money in to be greater than the money that's going out. It's going to be dependent on the size of your portfolio, the maturity of your portfolio, whether or not it's going to be a positive number or a negative number.
Correct, yeah.
And that's something obviously you can work through with your accountant. But I think the important myth here is that property is a lot more than just thinking that money's going to come into your bank and it's going to be happy days.
Yep, manage your business.
Manage your business, manage it well. Our third myth that we want to debunk, and this is interesting, and to give some sort of a background or context to this, I'm a journo. My job is to chat with property investors, and I've been through the process so many times of chatting with property investors thinking that the right type of property to buy is something which is a premium property in a premium suburb that's X number of kilometres from the CBD. And these are all important stuff. It comes down to the fundamentals of buying a property. But one of the myths, and I think this is a really important one that we should debunk, and you should start thinking potentially differently about. The myth is investing in low socioeconomic areas is bad because the tenants will trash your house. And you guys hear this all the time. I hear this all the time. It annoys me a bit that the people have this. It annoys me from two levels. It's a stupid way to think, but also it's not a smart way to think either in terms of building a property portfolio.
Yeah, that's really well, I suppose, put. It annoys the hell out of me as well because there's an element. What you're saying is you're painting a whole area with a bad brush of crazy, no good people. And let me tell you, we're in North Sydney at the moment, and I can guarantee that there's a portion of dwellings here that'd have some undesirables in it as well, even though the average price is around about $2 million. So to paint a whole area with a brush like that, I think is poor form and not very smart. There is a few, I suppose, things that people think about these areas being untardy. What about if the tenant kicks the place in or whatever it may be, which just doesn't happen, at all. I think rather than thinking of them as a lower socio-economic area, which is a pretty horrific tag, we tend to talk about them as a more affordable corridor at the end of the day, because these areas do transform over time, and it's where the smart money, so to speak, is. Better cash flow, better entry point. Right. And not everybody's in the same financial scenario where they can go out and buy $600,000-$700,000 investment packages. Not everybody can afford the negative cash flow on that, so they do look to the more affordable corridors where perhaps the cash flow is a little bit better. In some instances, the entry price is lower, so therefore the deposits required aren't as large, and they spread their risk.
And then these are the areas, of course, where usually the infrastructure tends to go in sooner rather than later. Because if you look at the more established areas, such as your North Sydney, the infrastructure is pretty much there. There's not much else we can do. Whereas if you went out further west, the upgrade of the infrastructure follows the population. So as the population increases, there's a natural push to get the infrastructure in place, or better infrastructure in place, which then creates that growth again. So it helps push along the growth as well in that area.
Well, let's go. Why do you invest in property? You invest in property for the property to go up in value, and hopefully the rent will cover the mortgage repayments and other costs associated with that. That's what you want, right? So you want both. You want yield, you want capital growth. Now let's talk about specifics with this. So we're in Sydney, North Sydney right now. Let's talk about areas. Let's talk about perceived lower socioeconomic areas. Let's talk about Campbelltown. Let's talk about Liverpool. Let's talk about Penrith. Let's talk about Blacktown.
Mount Druitt.
I've got properties in all those areas and I've done exceptionally well out of it. The whole notion, and let's say a fifth of the Australian population lives in the western suburbs of Sydney.
Well, it's called a mortgage belt for a reason,
It's called a mortgage belt. It is massive. We've done exceptionally well as property investors out in those areas. Myself, I grew up in Blacktown. I know the area well. And this goes back to that first thing about it's just idiotic to think that people in these areas are going to trash your house. It's not sensible. So my point would be, if you've got any of these preconceived ideas about this, speak to people who invest in those areas.
Yeah.
It'll probably completely change your paradigm.
Or even take a drive out there, because a lot of people have never been to those areas.
But even still, like if you take, because you mentioned Blacktown, so Blacktown Shire where you grew up.
Yeah.
So let's go pre-boom, or pre-buoyant prices, we'll call it, over the last 5 years. The Blacktown Shire encompassed areas such as Mount Druitt, which had a not so good rap or a stigma attached to it, which is...
Mate, flanos, Ugg boots.
which is how we get around, right? But in the same Shire, you also had some parts of your... I'm not sure if Kellyville is, but...
the ponds are part of Blacktown.
Yeah, so the ponds of the Blacktown Shire. So this is where when we talk about ground truth and not being reliant upon data, which is extremely misleading. So you had this one Shire that had opposite ends or bookends, $1 million suburbs, and at that stage, pre-GFC or pre the boom, $200,000 suburbs. Yet people want to talk about the Shire as this one
collective,
one collective asset, when it's not. And this is once again ground truth: markets within markets, suburbs, streets. It all comes down to that, to be that definitive.
Yeah, and irrespective of whether it's Sydney or Melbourne or Brisbane, you want to debunk a myth pretty quickly. Get in a car. Let's talk about Sydney and drive down Windsor Road now. Go and have a look. Go past Bella Vista. Look at the infrastructure going in there. And Victor, your point, and we're talking about this as property investors. Your point that infrastructure follows population growth. Now, what makes property a good investment? Why is property going to go up in value, and why are you going to have demand for people to rent it? It's because
of population pressures.
It's about population. Yeah. So population increasing, big tick. Wages out that way are increasing.
That's right.
Big tick.
Yep.
Infrastructure's massive. They're getting a brand new train line out in the western suburbs, but even through Liverpool and Campbelltown, the same levels of infrastructure, and Penrith, the same level of infrastructure, the same level of investment from the state government. It's absolutely huge. That's where they're spending the money right now.
And it has been for some time. So on one side of the coin, you've got the infrastructure follows population growth. But if you go to these so-called lower socioeconomic areas, but we'll call it the affordable corridors, and you do take, because you mentioned Penrith, and you do take your St Mary's, your Mount Druitt and your Blacktown, I'd challenge anybody to say that already didn't have the best infrastructure that you could possibly hope for. So you had your schools, your stations, your massive shopping centres, your hospitals, a bus industry, a bus stop every 100 metres. It already had it there, and it was there because that's where the mass population is. What people tend to think is that you're out in the sticks somewhere with, no job prospects. There's no money in the economy spinning the wheel, so to speak, and that's actually the most furthest thing from the truth. But people have this preconceived idea because they heard from someone who knew nothing about anything, but that's got to be the truth. So I'd say get off your backside, go out and have a look.
Do it. And what frustrates me the most about this myth is that I wish I could be buying properties out there right now, but it doesn't make sense for me to be buying there
Not
right
anymore.
now. The growth, a lot of the growth has happened,
Yeah.
and we need to wait for another cycle really for that. And there's still good buying opportunities out there, but my money now is better spent in
Elsewhere.
areas like the western
Just
suburbs
like
of
it.
Sydney,
Yep, that's right.
in other states.
And there's a
that's
couple of
where-
reasons for that. One is because our strategy is about cash flow and growth. So, you can have all the growth in the world, but if you haven't got the cash flow to support that growth, you've got nothing because you can't afford to hold it. We like to have the combination of both, where our risk mitigation is in place and we can sleep at night.
It's good. All right, let's move on to our next myth, which is never buy units, only buy houses.
That's a good one. In fact, I think this could be a topic for one of our later months as well, because a lot of people miss out on good equity gain and good cash flow by just concentrating on houses. In my portfolio, I've got a blend of houses, townhouses, units, and larger parcels of land. It needs to be balanced, obviously. And of course, if you're buying units, you need to look at what the strata costs are. So if you're buying in a unit complex with your gym, your pool, your
Concierge.
that's right. Yeah, you're asking for trouble as from an investment point of view, because obviously your strata fees is going to be substantially high. So that's the only thing that I'd look at when I'm differentiating between a house and a unit is to actually take into account the strata fees and compare it cash flow wise. So that you've got a blend of properties in your portfolio.
It's probably the biggest question we get.
Yeah,
Get
absolutely.
asked, hey, so
Yeah.
I'd rather a house than a unit. It's a bit like I'd rather city than regional, which is a whole other episode, I suppose. Look, I think Victor's pretty much nailed it. You really got to be looking at the cost to operate of the unit, and that includes your strata fees, obviously. And the best way to really look at strata fees is just think of it as a kitty or a holding fund that you contribute to on a quarterly basis to take care of external maintenance and repairs, generally speaking, as opposed to your house where you're up for everything when it happens. The other thing that I would also say about, and I'm not saying units are better than houses, just as a prerequisite, as Victor said, you do need a blend. And the reason that we buy units or townhouses or villas, for that matter, is usually because they're based on better infrastructure, because the zoning's different from out in the burbs, so to speak. So they're closer to the hubs of transport, schools, shopping centres, whatever it may be. And they also provide, generally speaking, better cash flow, better net cash flow if you buy in the right complex. And that's buyer beware, of course. And as we've talked about before and probably talk about in future episodes, is getting that balance of cash flow and growth is absolutely essential. So, we talked about in the prior episode, and we probably will every episode, about your portfolio's a business. Well, then your cash flow and the types of properties, and as your portfolio sort of evolves, is about balancing the books. So you need cash flow and you need growth, and they come in different forms of property.
At different times.
At different times.
Yeah. Okay, our next myth, and this one I really like, and I hear it all the time, and you guys as well. Buying new is better because of the depreciation benefits. And I might extend that a little bit further.
Sure.
I'm going to say because of depreciation benefits and also negative gearing. A negative gearing strategy.
Yeah.
New is better for a negative gearing
Yeah.
strategy.
Yeah.
What do you guys reckon about that?
How long you got?
So it's probably its own episode, no doubt.
Yeah, and this is usually the advice from a ill-advised accountant or financial planner, or even perhaps a strategist. It's not that good. Is that you need to buy newer because you're going to get the high depreciation and you're paying too much tax, so you need the depreciation. That's just crazy stuff. And we won't go into the whole explanation of negative gearing and things like that. Just remember, cash flow is king. Why make a loss
Absolutely.
to get a little bit back? I mean, that's just, you would not do that as a business. Don't believe that you need to buy new to make money in property, and don't believe that you need to buy new to help, in inverted commas, with potential tax problems.
Yeah, you need to look at the property in its isolation. So take away the negative gearing, take away the tax benefits, work on cash in, cash out. So how much rent you're getting in, how much expenses you're paying out. So your mortgage, your strata fees if it's a unit, your maintenance costs, your insurance and all that. And if it works on that, and if it's a new or newer property, that's just a bonus. You just have to remember that we're talking two very different things. If you're talking about high depreciation, of course, you're talking about tax minimization. And usually when you got tax minimization, you can't have a contra strategy of wealth accumulation happening at the same time.
I saw this morning on my desk someone else's proposal from another company as to why you should buy a property. And it had some beautiful figures around it in terms of the paper it was printed on and the nice colours.
Nice brochures.
Yeah.
Nice brochures. But right down the very, very bottom it said, this will be your depreciation or allowance, which I thought was just crazy.
A
As soon as you
depreciation
start,
allowance, yeah.
yeah, so it was like $8,000 in the first year or something like that. So essentially what it was telling me was that you're going to get this $8,000 bonus in inverted commas because you buy this property as a tax rebate. And as Vic said, if you're even contemplating purchasing any type of asset based on the tax advantages you're going to get around them purely, and that's your defining decision, or that's what's going to help you make a decision, yeah, you deserve to lose money.
What I like about you guys, and this is I'm not going to preface this and give you a hard time, but what I do like about you guys, that whenever you talk about property, you always talk about gross rather than net.
Absolutely.
So gross, and this is what you were saying, Victor. You got to look at the
bigger
money in,
picture,
money
yeah,
out, right?
that's right.
Let's talk about it. If you can invest in property and not need the tax benefits associated with it, that's what you should be striving towards. A lot of people get caught up thinking it's a negative gearing strategy, and a really good property spruiker or accountant will talk to you about this. They'll be talking about the net figures. So after everything else is included, you're going to be neutrally geared, right? You've got to be talking about the big end of town, the top numbers.
Cash flow.
in, cash
money
out.
in, money out.
You have to treat the tax as a bonus, and every year, every election cycle, every end of financial year, the same thing rears its heads up in the sense that, okay, what if they take away the negative gearing? So we have a lot of investors that live in fear because they've gone down the path of brand new properties or high depreciation purely because of tax reasons. And coming back to Steve's comment in terms of the slick brochures and all that, look at the fine print. It's usually based on a particular figure that the depreciation's worked out on.
Your
and
income.
how much, yeah, that's right.
And which is crazy.
Yeah, it won't be your income. It's a figure that they've chosen. So you need to bring it back to your own financial situation first.
Yeah.
Yeah, and like I said, we wouldn't get into this whole debate about gearing, negative gearing, and what have you. But yeah, we go back to the election where they're going to take it off the table and what have you. So the fear of God was in a lot of investors and say, well, what happens now? What happens now? We sat back and said, yeah, do it, abolish it. Yeah, it'll just create opportunity within the market first, and then they'll realise what will happen and they'll reintroduce it, and we'd have said ourselves, if your whole portfolio is based upon your taxable position and what you're going to get back at the end of the year to be able to survive, then you should get out of property. Dangerous ploy.
So this sort of myths expand a little bit, that there's no such thing as investing for a tax strategy. There's no such thing as a tax strategy. Tax is an outcome.
It's a byproduct.
It's just a byproduct.
Yeah.
Yeah, absolutely.
Okay, good. So our last myth that we want to debunk, this is a good one. You only buy within 5 to 10 kilometres of the major CBDs. Victor, probably 6 months or a year ago, I remember chatting to you about this particular thing, and you have a really interesting view of this, where if you look at the growth of properties in Australia and the way Australians live, and let's go back to an example of the western suburbs of Sydney, you've got Campbelltown, Liverpool, Blacktown, Penrith. They're all Parramatta. They're major CBDs in their own rights. People, if I live in Campbelltown, I might commute to the city for work, but most people live, raise their families, entertain themselves, all within that Campbelltown area.
Absolutely. And to bust this myth, you've got to look at where the employment cycle is. So in the early years of industrialization and then the IT information and so forth, all the work was around the city. So, your postcode 2000, postcode 3000, and within 5 to 10 kilometers. So that's where the mortgage belt was back then. That's where the working community was. And the people with wealth were actually living out in the suburbs on acreage. Now it's done this complete flip around where the work is distributed out because of better logistics now. So we can get employment hubs such as, if you're talking New South Wales, your Liverpools, your Campbelltowns, your Blacktowns. So the adage still applies that you buy within 5 to 10 kilometers of CBD, but the definition of CBD has massively changed, where you've got your sub-CBDs like your Parramatta, Liverpool, your Blacktowns, rather than your Sydney postcode 2000. And that's what we need to keep in mind, that all of these principles need to be adjusted for time and where the property cycle is and where the economy is.
100% agree. And I think, we're still looking at rare earth commodity here.
Absolutely.
So closer to the CBDs is obviously more attractive in terms of commute time and what have you. But I think, as you said, today's technology has allowed these so-called blue chip areas to expand as to where they are. People starting to work from home. There are satellite offices. If you look out to where our office is in the Hills District of Sydney, you go back there 10 years ago and it was nothing compared to what it is today. But today it's rare earth. People need it. People want it in terms of commute times. Now, having said that, not everybody can afford the 5 to 10K round kilometre range around these CBDs. So it's once again being able to invest where you can afford.
And I think it goes also to our original comments around why property goes up in value, and that's around infrastructure. So
That's right.
Where are our state governments investing right now? They're investing in new areas. Let's go back to Sydney paradigm. It's your hills area. There's massive growth out that way. Penrith, Liverpool, Campbelltown. That's where the government's spending money right now, because that's where people want to live. And because people want to live there, there's getting the amenities in there. More people want to live out there. Where are our populations heading to? Our new migrants, they're heading out to those areas.
Mm-hmm.
You know, that's where the money is.
And as with anything, it's it's cyclical adjusted though as well. You don't want to be buying it at the wrong time of the market, no matter where it is. But we're talking about 5 to 10 k's of the major CBDs, and the type of property as well. So if you were to buy in any of the major cities throughout Australia now in that 5k range of the CBD, and we'll talk about postcode 2000, 3000, 4000, and you were buying units. Well, I don't think you're going to have much of a ride in terms of growth over the next couple of years, just due to oversupply. Yet, if you are able to secure detached dwellings in some of these areas, or larger block of lands for the right price in these areas, well, then it could be quite the reversal, and you might make a bit of money.
Yeah, but so the same holds true if you're still wanting to invest within 5 to 10 kilometres of the Sydney CBD. It's the same logic as investing in 5 to 10 kilometres of Campbelltown or Liverpool.
Pretty much.
Just your price point's going to be
That's right.
slightly
Price point and
different.
cash flow
A lot lower.
is going to be different.
It's good.
Yep.
All right. I think that's the end for episode 2 of our education series. Thanks for tuning, everyone. I really enjoyed these. This is good. I'll quickly summarise episode 2. So what we've tried to do here, and I think we've done a pretty reasonable job trying to debunk the most popular property myths. So the first one was property set and forget. The second one was all you have to do is collect the rent, and we sort of framed them around property being a business, and you don't want to be asleep at the wheel. You've got to invest time to be successful. At certain times, your property portfolio is going to require more work than other times, and it's depending on whether you're buying or selling or what your current situation is. But you need to keep aware, you need to be responsible. Our third myth was investing in low socioeconomic areas is bad because the tenants will trash your house. I think we covered that pretty well and made our position quite clear on that. Look for opportunities. The next one was never buy units, only buy houses. And I think we sort of said a blended portfolio would include both, but there is reasons why you would buy units over the reasons why you buy houses. Our second last myth was buying new is better because of depreciation benefits. And that holds true, and that sort of expanded into the notion of a tax strategy. And tax is not a strategy, it's an outcome of investing in property. And I think the term you used was tax benefits, which is a product of investing in property, and a good accountant can help you out with that. And the last myth, which I really enjoyed, Victor, was only buy within 5 to 10 kilometres of the major CBDs. What we're saying is that 5 to 10 kilometres of the major CBDs, so your 2,000, 3,000 postcodes, if you can get in there and it suits your strategy, absolutely brilliant.
Good luck.
But don't frame your idea of a major CBD by those major postcodes. Every state, every city has satellite cities within it. Your Ipswiches, for example, out in Brisbane is a really good case in point. They're out there. So don't frame your strategy being 5 to 10 kilometres of the major CBDs. You need to look at what a CBD entails. And a CBD is an area that's going to include all the amenities, business, industry, jobs, entertainment, sports fields, hospitals, everything. So
and a growing population.
And a growing population, which is absolutely key. So thanks, guys. Anything to add before we close off?
If you've got any questions along the way, don't forget to
get in touch. So
email us.
Yeah, email. So you can email questions@rightpropertygroup.com.au. So if you go to smartpropertyinvestment.com.au, where you're watching or listening to this podcast right now, you'll see some of the topics that we have coming up. If you want to know anything particular about those things, please get in touch. So send your questions to questions@rightpropertygroup.com.au, and we'll make sure we cover them off. Phil Tarrant here. I'm the editor of Smart Property Investment. I've been joined in this episode of our education series with the guys from Right Property Group, Steve Waters and Victor Kumar. We appreciate you tuning in, and we'll see you next month.